Hi, this is Kevin from Excel Coaching. Trust you have been enjoying our recordings on the various finance topics. For more up-to-date information, please do not forget to subscribe to our YouTube channel. In this session, we'll focus on debt financing. Financing is a key decision an organization needs to make. Whether you're a large listed company or you're a small business, this is an important decision. Broadly speaking, there are two types of financing. Number one, equity financing. Equity financing is when money is sourced from within the business. Examples are your private savings if you are a sole trader, or you can be getting some money from family and friends. You could also source equity financing from angel investors or venture capital. With equity financing, one of the downside is you are giving away or diluting the right of decisions or share of future profits. The second type of financing is through debts. This could be business loans, lines of credits, overdraft facilities. Larger organizations can also issue bonds. The focus of this recording is to help explain debt funding in some detail. So, what is a debt? A debt is money which is borrowed. A key feature of a debt is the interest you have to pay. For example, your business requires $50,000 to buy some new machinery. You approach a bank and get it financed by a business loan. This $50,000 borrowing will have some key terms, including when the $50,000 need to be repaid by, and the cost of a debt, that is, the interest charge. For many of us, we have always been taught debt is bad. But what are the issues with debt financing? Number one, with debts, there's an interest rate repayment. Interest rate, depending on your debt instrument, can be quite high. For example, some loan sharks can charge your business very high interest rates. Can you or your business afford this repayment? Number two, debt is a liability. It can be short-term or long-term. This can impact on your financial ratios like gearing. Gearing ratio measures your debt to equity in your business. Taking more and more debts will increase your gearing ratio, and this may signal high risk to your lenders, suppliers, and so on, which in turn can lead to more unfavorable business terms. Number three, excessive debts can also impact on your credit rating or credit score, which then has an impact on your credit worthiness. A bad history with debt can make it difficult for you to access debt when needed, or if you are given the debt, very high interest rates will be charged. In the previous slide, we learned that debt financing has some drawbacks. But is debt financing always bad? Let's say your business can borrow $100,000 at an interest rate of 4% per annum, and you invest this $100,000 to generate 10% return. This means after repaying the interest of 4%, you will have a net return of 6%. In this example, taking debt is positive. Conversely, say you use that money to buy a luxury boat for entertainment. This boat may not be giving you any financial return, and yet you will be paying 4% on that luxury item. This may be classed as a bad debt. If we look at the current economic landscape, there are some very cheap debt available. The cash rate is at historical low level. On the left hand side of my screen, I have the cash rate for US and Australia. Cash rate, in very simple terms, is a reference rate that banks have to pay the central bank or reserve bank on money they have borrowed. The cash rate, alongside other matrices like risk and margin, are used to derive the interest rate you pay on your business loan and mortgages. With a cash rate very close to zero, debt funding is quite cheap. If you can access cheap debt funding and use it productively, this can generate a good return. Therefore, in a nutshell, debt financing is not always bad. Alongside the very cheap cost of debt financing we have these days, the other advantages of debt financing is that the interest repayment for many businesses is a tax deduction. This can differ based on your tax laws and jurisdictions, but generally speaking, it is a business tax deduction. Also, unlike equity financing, you retain control. That is, you're not diluting your shareholding when you're taking new debts. Thank you for watching our recording on debt financing. I trust this has clarified some of the issues with debts for you, but also highlight when taking a debt can be a good thing. If you like our recording, please do subscribe to our channel. There's a subscribe button underneath the recording or by clicking on the Excel Coaching logo. Until next time, thank you.